In a matter of minutes, I am going to show you all you really need to know about how to build long-term wealth. I'm going to show you what the best financial advisors in the business know, and I'm going to do it in plain English. My name is Reese, and I'm a chartered investment manager, a fellow of the Canadian Securities Institute, and a financial planner. But I also have a degree in communication, so don't worry. I'm going to explain some ridiculously profitable concepts to you today, but I'm going to do it in a way that's really easy to understand because, frankly, most of the key things that we know as financial advisors are not that complex. They're not. Now, it doesn't mean that they're easy to implement. In fact, many of them are not. Many of them require a lot of discipline and fortitude. But what I am saying is that there are really just a few very key facts that, when acted on, lead to dramatic long-term results. And these facts aren't ethereal. You can grab them and run with them. They're intuitive. They make sense. And I know this because I explain these facts for a living, and I watch light bulbs go off left, right, and center. And people are often amazed at how quickly they can grasp what 15 minutes ago they thought to be totally out of their depth. So let's do it. First key fact: owning is where it's at. Yes, you can make money by working, but once you have money, you want your money to start working for you, 100%. And when it comes to making your money grow, you really only have a couple of options. You can either own things with it, or you can lend it out. You can be an owner, or you can be a loaner. And yes, I know there's some financial wizardry out there, contracts, derivatives, and blah, 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 but you don't really need to worry about any of that jazz. Owning and loaning, that is what really matters, and everything else is just built off of them anyway. Now, of course, there's a lot that could be said about how owning and loaning works, but I don't want to get into the weeds in this particular video. What you really need to understand is the long-term implications of each. What do you get if you do one versus doing the other? Now, to keep this super high level and very practical, we're going to look at a chart from the Ontario Securities Commission. And we're going to go as far back in time as this chart will let us, 1935, smack dab in the middle of the Great Depression. Now, for the sake of time and keeping on task, I want to focus on three of these lines: US stocks, Canadian stocks, and government bonds. Don't worry, these are all easy to understand, and I'll explain them in a sec. But what you're looking at here is the journey of a $1,000 investment in each of these categories from 1935 to what looks like the end of 2022, give or take. It's important to note that this is not a $1,000 investment each month or each year. This is a one-time lump sum. You just dropped it in, walked away, came back 87 years later, and these were the results of each of these investments. Now, obviously, this is a longer time horizon than what most people have, but go ahead and chop 20 years off of the front or the back end of this chart if you like. The concept is the same. And actually, if you're interested in building a portfolio that will outlast you, then you might as well just look at the whole thing, because it's just the same story. It's just longer. So let's start with the top investment option here, light blue. US stocks. Your $1,000 investment turned into just over 13 million. That, no matter how you slice it, is breathtaking. Now, it was a bumpy ride along the way, for sure, sometimes very bumpy, but clearly it paid you for putting up with these bumps. Clearly. This is owning. A stock is owning. It's a piece of a business. And so if you buy stock in a business, or shares as they're also called, then you own a piece of that business. And the more shares of that business you own, the more of it you own. And just in case you don't know, a stock market is just a place where you can buy and sell businesses that are for sale to the general public. That's it. It's nothing magical or scary or dangerous. It's just a market. It's just a place where you can buy pieces of some of the world's biggest and best companies. And you can sell them there too. Anyway, this line here is showing you what the whole US stock market did over this period of time. And if you owned it, good for you. I just want to quickly point out that there's nothing to argue with here. This is just data. This is a snapshot of time. This is what happened. The next line down is the red one, Canadian stocks. Same story. This is just showing what the Canadian stock market did over the same period of time. And if you owned it, good for you. Not quite as good, 3 million versus 13, but still a pretty attractive return on your $1,000. Now, I wish there was a line in here that showed us what the long-term return was on US and Canada real estate as well, but there isn't. But for the record, it's the same basic story. If you own something, it's yours. And if it grows in value over time, well, that can be really good for you. Now, let's flip over to loaning. Of course, there's a whole bunch of different ways that you can loan, but we're going to keep this simple. Did you know that whenever you put money into a bank account, you are actually lending money to the bank? They do not take your money into the back room, into a little box with your name on it, and then put some interest in there every once in a while. That's not at all how it works. You are lending them the money. And they are giving you maybe 2-3%, but then they take all that money that is being lent to them and then they lend it back out to others, maybe even right back to you, and charge you 5, 6, maybe even 7% for your mortgage or whatever. It is very, very profitable. And it gets way deeper than that, but we're going to stick to the point here. But that said, knowing what you now know, let me ask you this. If someone were to give you $50,000 to invest, and you could go back in time 40 years with that 50K and either lend it to the Royal Bank of Canada and take whatever interest they were offering you all along those years, would you do that? Or would you go back and purchase $50,000 of stock in RBC and join them in their profits over the next 40 years? Which do you think would have worked out better for you? Please feel free to leave comments below. I'm interested to hear what you have to say about this, but I'm going to give you a hint. It wasn't loaning. Now let's get back to the graph. Let's look at the orange line now. Government bonds. Now a bond is just another way to lend money. It's a bit more sophisticated, but at the end of the day, it's still lending. And there are different kinds of bonds. For instance, a corporate bond is simply how you lend money to a corporation or a business. And a government bond is just how you lend money to a government. And obviously there's lots more that we can say about bonds, but none of it really matters for our purposes today. What matters is this chart. If you would have taken your $1,000 and loaned it to the government, you would have ended up with $131,000. That is staggeringly less than any of the owning options, which begs the question, why would anyone do that? The answer is the shape of this orange line. It is far less bumpy or volatile than any of the owning options. It is a far smoother journey, far smoother. That's why people do it, to avoid volatility. In fact, there are loaning options such as guaranteed investment certificates, or GICs as they're usually called, that have absolutely no volatility associated with them at all. A very, very smooth journey, no bumps, but it is the exact same story in the end. A dramatically smaller portfolio that is fighting just to keep up with or squeak ahead of inflation. This is not something that professionals in our industry debate. We're not waiting for more data to find out how these two paths are going to match up over the long run. We know. The data is in. It's been in for a very long time. If you are looking to outpace inflation and grow your wealth over a long period of time, it's not just a good idea to be an owner, you have to be one. And yes, it'll be a bumpy ride. The economy does not shoot up in a straight line, never has. Trouble comes, but every day humans wake up and they look for ways to get around the troubles that are in front of them. They look for ways to better themselves and better their families. They pursue growth. And billions of us are doing this all around the planet all of the time. And businesses are the same. Some are better than others, obviously, but at the end of the day, they are all looking for ways to get around whatever problems are in front of them and generate profit. And some of them are amazing at doing it. In fact, lots of them are. Just look at this graph and think about the enormous challenges we faced during this time period. It's crazy. The Great Depression, World War II. I mean, think about it. Hitler nearly took over the world in the 40s, literally. Obviously, the stock markets had a rough time during much of that period, but humans woke up every morning thinking about ways to get around the problems that were in front of them and make their worlds better for themselves and their families. and look at the results. Staggering growth. Staggering. See, when we invest in businesses, we aren't just investing in some corporate entities. We are investing in the humans that make up that business and the humans that affect that business. And frankly, that is what leads to profound long-term growth. It's humans. Second key fact, every bear market in history has been an incredible opportunity. Whenever a society or the world in general is going through a crisis, it freaks people out. And usually there's pretty good reasons for being concerned. Whatever the problem or problems are, they need to be fixed. They need to be dealt with. But during these times of instability, people can get very concerned about their money in particular. They don't want to lose it. And so they start to sell their investments to remove them from potential harm. And as more and more people pile into this exact same maneuver, it pushes the value of pretty much all the shares down until we end up with a self-fulfilling prophecy. The stock market as a whole tailspins as the masses seek to get out while they still can. And that is what a bear market is. Different people have slightly different definitions, but a common one is simply a drop of 20% or more in the overall stock market. Now, if your belief is that the current crisis that we're going through is the one that we are never going to recover from, then it would make a whole lot of sense to you to sell your investments and get out. Even if you're selling at a loss, because hey, at least you won't lose it all, right? The problem with this line of thinking is that so far, every time it's been wrong. Every single time in recorded history that developed markets have gone through a bear market and dropped in value, they have come back and not only matched their previous highs, but left them in the dust. And yes, we're going through some stuff right now that have us off of our previous highs at the moment, but the only thing that really means is that we are at one particular phase in the grand economic cycle that repeats itself over and over and over. And I know that many people think that they can hop out at the right time and then hop back in at the right time to avoid the pain on the way down and yet get all the gains on the way back up. Sounds awesome. But that requires being right on both the way down and on the way up, which in history has proven dramatically more difficult than most people imagined. And a lot of people have lost a lot of money trying to dance through this minefield. But that's a whole nother topic for a whole nother video. Fact is, what history shows us is that if you simply do nothing, grit your teeth and hold on, you come out the other side entirely intact and off to new highs. But the story doesn't stop there. Many businesses pay dividends to their shareholders or the people who own their stock. Or in other words, they take some of their profit and they send it out of the business to the people who own the business. Take McDonald's, for example. When we go through a bear market and we see tough economic times, chances are the share price of McDonald's will go down like pretty much everyone else's. But they're still making money. In fact, in tough economic times, they might even make more money because lots of people might not be able to afford higher end options. And so more people are eating at McDonald's. I don't know. I'm just making this up to prove a point to you. Their share price might be down 20% because of the overall fear and panic in the environment, but they are still making money. They're flipping cheeseburgers and slinging fries like no one's business. And so they can take some of that profit and pay it out as a dividend to the shareholders, the people who own a piece of McDonald's. And depending on how you have things set up, you can just take those dividends and buy more McDonald's stock with it, or whatever company you own. You get the point. But since the price is down 20%, you're actually buying it on sale. And you don't even need to come up with any extra money out of your pocket to do it. You're just using the dividends. And this is a huge key to building long-term wealth. Rather than seeing every downturn in the market as a crisis, you see them for the opportunities that they are. Rather than running for the hills or selling your businesses at a loss, you go shopping and you purchase some of the world's best and most profitable businesses at prices that you never even dreamed that you could get them at. Basically, if you're getting shares at 20% off, then you're able to buy way more than you would have if they were still at full price. So your stack of stock grows at a rate that it never could have if there hadn't have been a downturn. Just look at this chart. Every single bear market, every single large dip in the markets was an opportunity. Pretty much everyone watching this video would do almost anything to be able to go back in time and throw in as much as they could during any of these crisis periods. The deeper the crisis, the bigger the sale. And let me be blunt, the world's wealthiest people are business owners, hands down. And while the world is on fire and there's panic and chaos in the markets and people are selling some of the world's best businesses at rock bottom prices, the people who understand money and how the world works are buying them. Market downturns are opportunities to grow your wealth faster than is otherwise possible. It is wise to prepare yourself for this mentally, to not only be a business owner, but to think like a business owner and to build a war chest, a side pot of money to be able to take advantage of these crises when they come, because surely they will come. Key fact number 3, financial journalism is garbage. I'm not saying that every piece of financial journalism is wrong per se, but I am saying that most of it is speculation, nonsense, and clickbait. If you never read another article on the stock market or the economy, you will be a happier and less anxious human, and probably a far wealthier one. I could spend a bunch of time discussing the state of journalism around the world right now and how it's going through a particularly disgusting phase, but I think we all get it. If it bleeds, it leads, because that's what makes people look. And so therefore that's what sells ads. Who cares if it leads to you making better financial decisions for yourself and for your family? That's not the point. Selling ads is the point. Just look at these old Time magazine covers. These get passed around quite a bit in the advisor world as a reminder to ignore all the noise. And they're a great reminder. I love these. EdgePoint put this particular piece together, and what they're doing is illustrating what your rate of return would have been 10 years later had you invested in the S&P 500, which is 500 of the biggest and best companies in the US, on the day that each of these issues hit the stand. I like this one. September 9, 1974. Picture pretty much says it all. And you can imagine how a lot of people were thinking back then. Oh, things are not looking good. I better get my money out, or definitely not invest right now. I'm just going to wait until the situation stabilizes and then I'll invest. But look, had you invested that day, your cumulative return would have been 286%. If it bleeds, it leads. Never mind the fact that that turned out to be an incredible long-term opportunity. Now, I'm not going to make you sit through all of these, but I will point out one more. November 2, 1987. The crash. After a wild week on Wall Street, the world is different. Really? How so? Was that the end of business? Was the economy broken beyond repair? Were humans finished finding solutions to problems and looking out for the long-term well-being of themselves and their families? Well, let's go back to our history graph and take a look. There it is. There's the crash. A huge drop. Panic, pandemonium. But what happened after? One of the most stunning, long-running stock market increases of all time. Had you invested on November 2nd, 1987, after 10 years, you would have had a cumulative return of 379%. Massive. I like the last page of their piece here as well. It shows what the average annual rate of return was 10 years later for each one of the dates these different issues hit the stand. 14.28% a year. Huge. And here's the investments that lost money 10 years later. Love it. It's zero. In sum, financial journalism is an utter waste of your time. It's noise. Now, please hear me. I am not trying to convince anyone of anything. I am simply telling you what the best financial advisors in the industry already know to be true. Are there other factors to consider in everyone's individual situation? Absolutely. Should you put all your eggs in one basket? Absolutely not. Are there ever any situations where it actually makes sense to be a loner? Totally. And you can learn these things. Or you can find an excellent advisor who will teach you and show you how to apply these to your specific situation. Building wealth is not easy, but it is simple, and you can do it.